Moving on, in a landmark move that could reshape the global economic landscape, Southeast Asian leaders held their first ever summit with China and the Gulf Cooperation Council.
The most powerful alliance of the decade was just born, and the West wasn't even in the room. In May 2025, China united with Southeast Asia and the Gulf states to launch a $25 trillion economic coalition, quietly, without a single headline in Western media. No cameras, no speeches, just game-changing deals that could crush the US dollar, bypass global trade norms, and flip the world order overnight. In May 2025, while global headlines chased scandals and distractions, a far more important meeting was happening, almost unnoticed. In Kuala Lumpur, leaders from China, the 10 ASEAN nations, and the 6 Gulf states came together for a high-stakes summit that quietly rewired global alliances. This wasn't about press photos or diplomatic small talk. It was a working session where 20 nations laid the foundation for a new economic and political framework. Their agreement focused on 5 key areas: trade expansion, cross-border infrastructure, clean energy cooperation, digital innovation, and cultural ties. ASEAN and Chinese officials confirmed that multi-billion-dollar projects are already underway, linking ports, streamlining payment systems, and reducing dependence on the US dollar. No slogans, no theatrics, just action. While Western powers debate, this bloc is designing the next chapter of globalization and doing it on their own terms. China, ASEAN, and the Gulf states have now combined into a trade bloc worth over $25 trillion in GDP, connecting more than 2 billion people across 2 continents. According to IMF data from April 2025, this group now drives 55% of total global GDP growth, a larger share than North America and Europe combined. Trade between China and ASEAN is already 54% higher than US-China trade and rising fast. Gulf nations are backing this shift with serious capital, aiming to grow ASEAN trade from $130 billion in 2023 to $180 billion by 2032, based on projections from the GCC Secretariat. Target sectors include renewable energy, artificial intelligence, digital banking, and logistics infrastructure. These countries aren't just growing, they're integrating. And with fewer deals now involving the US dollar, the ripple effects on global markets are starting to show. China's trade partners aren't waiting for legacy systems to catch up. They're building new ones. This alliance includes plans for cross-border railways, maritime logistics hubs, and port expansions linking Southeast Asia with the Gulf. The Chinese government and Gulf sovereign wealth funds are co-financing infrastructure projects designed to bypass choke points and speed up regional trade. Alongside transport, tech is a core focus. The UAE and Saudi Arabia have committed funds for joint AI research, data centers, and 5G expansion, creating a digital backbone for the alliance. These investments will be tied together through interoperable digital payment networks, reducing reliance on the dollar and anchoring trade in local and regional currencies. This isn't a concept. Construction has started, contracts have been signed, and the systems are being activated. In April 2025, the U.S. government imposed steep new tariffs, up to 40%, on goods from 6 ASEAN countries, including Vietnam, Malaysia, and Thailand. The move was branded Liberation Day by former President Trump and framed as a win for American workers. But the result was very different. Instead of isolating China, the tariffs pushed ASEAN and Gulf states deeper into Beijing's orbit. Just 2 weeks after the tariffs were announced, ASEAN released a 5-year regional integration strategy aimed at cutting dependence on Western markets and deepening internal supply chains. At the same time, GCC ministers publicly declared a shift away from politically unstable trade partners, a clear reference to Washington. By trying to box China in, U.S. policy helped consolidate an even stronger bloc around it, one that is now openly challenging the Western trade system with unified planning and coordinated investments. One of the most surprising moments at the summit came from Indonesia, a longtime U.S. military partner and the world's largest Muslim-majority nation. President Prabowo Subianto, newly elected, stood alongside China's premier and praised Beijing's firm stance against colonialism, foreign domination, and occupation. He also applauded China's vocal support for Palestine, calling it a matter of shared moral responsibility. The message was impossible to miss. For decades, Western powers tried to drive a wedge between China and Muslim-majority nations using issues like Xinjiang. But this summit showed a different reality. Indonesia's leadership didn't just tolerate China's presence, it embraced it. And that shift didn't happen in isolation. Gulf leaders nodded in agreement, showing that religious, strategic, and economic loyalties are realigning. The West may still view China through an outdated lens, but many of its closest allies are now seeing a partner, not a threat. Western media often frame the South China Sea as a conflict zone dominated by Chinese expansion. But at the recent summit, Indonesian President Prabowo confirmed that ASEAN and China are now working together to finalize a regional code of conduct, a formal mechanism to manage maritime disputes and improve coordination. According to joint statements, the framework is designed to reduce naval incidents and standardize communication across disputed waters. Except for the Philippines, most ASEAN nations now support this approach, citing progress in bilateral talks and trade integration. New infrastructure projects tied to port security and shipping lanes are being developed with Chinese funding and engineering support. Leaders at the summit described the negotiations as constructive and essential for regional stability. The shift is visible in policy, planning, and shared investment, not in speculation. According to China's Ministry of Commerce, yuan-denominated trade settlements surged by 58% in the first quarter of 2025, compared to the same period in 2024. This growth reflects a steady increase in bilateral trade contracts being priced and cleared in the Chinese currency. Simultaneously, U.S. Treasury data confirms a 12% decline in Asian holdings of American government bonds, a shift that analysts say signals a regional move away from dollar-linked assets. In the Gulf, central banks in Saudi Arabia, the United Arab Emirates, and Qatar have begun testing cross-border payment systems using their own currencies, connected to China's expanding digital yuan infrastructure. These pilot programs include both public sector transactions and selected energy exports, pointing toward long-term integration. A Goldman Sachs report from May 2025 estimated that a 10% expansion in yuan-based global trade could reduce annual demand for U.S. bonds by as much as $210 billion. These shifts are already underway, backed by bilateral agreements, fintech collaboration, and new settlement frameworks that lower reliance on dollar-based clearing across Asia and the Middle East. The Kuala Lumpur summit marked the moment where strategic planning turned into operational action. Within 72 hours of the event's close, China's Ministry of Commerce publicly confirmed the allocation of initial funding to co-develop logistics infrastructure, including rail corridors, deep-water ports, and fiber-optic grids, linking Southeast Asia with Gulf economies. ASEAN's 5-year integration roadmap, released on April 30th, details regional targets through 2030, such as automated customs processing, interlinked payment systems, and joint energy pipeline development. These policy changes are already being translated into projects. The UAE's Sovereign Wealth Fund has committed $12 billion toward tech-linked infrastructure inside ASEAN member states, focusing on AI research parks, digital trade zones, and maritime logistics hubs. Shortly after, Saudi Arabia expanded its Belt and Road portfolio, adding new high-speed transport links and telecom ventures in coordination with Chinese developers. The alliance's model is now clear: infrastructure, digital connectivity, and alternative finance, moving in sync. This is not conceptual. The financing exists, the timelines are defined, and regional ministries have already begun formal rollout procedures. This alliance marks a turning point in global economics, one built without the West, powered by rising nations, and designed to last. Subscribe for more in-depth coverage of the moves quietly reshaping the world economy.